All right, we are going to get started here in a minute. 11:59, start at 12 o'clock. I believe the Zoom window set up correctly. We have charts in the background is my NinjaTrader introductory slide. Trading ladder on the left, quote board on the right. Sorry about that. Sorry about the echo. We're good to go though. If we can get let me get the chat going here too. There's a chat room somewhere here. There we go. I have the chat. Paulie, good morning. Good to see you. And I think we're good to go. Fernando. Sorry, I don't, my language skills are limited to English and I'm not even good at that. But LIFO, not sure what you mean by that. If you could somehow maybe throw that into Google Translate or something, that'd be great. Anisha, hello. Sounds like we're up and running. It's 12 o'clock, so let's go ahead and get started here. We had fun this morning at the Live Trade Setup event. Morph, thanks for the thumbs up. We had to fight a little bit this morning to get back to where we wanted to be, but we did fight a little bit and things worked out okay. Maybe we'll see you tomorrow at the live trade events. Today, though, we're talking about something different here. We're talking about the micro Nasdaq, macro Nasdaq 100 stock index futures. And, we're going to focus on that today. I have a PowerPoint, but we're not going to spend too much time on it. We're going to look at the charts a lot, quote board and all that stuff. And, the thing about the micros, it dawned on me that, there's this whole notion of fractional trading, right? You could purchase a fractional amount of an Apple share, as an example. It's kind of become a regular phenomenon, and it's the nice thing about it is you're able to match up your account size with the market you want to trade in a reasonable way. And I'm going to make the case today that the micro Nasdaq does just that. And presents us with some opportunities. So we're going to go into detail on this. We got an extra hour together. Anything I could do, type in questions. I'll try to pick them off on the fly. I do see the Zoom chat. I see the YouTube chat and the Facebook chat. I'm going to rely on my colleague Isabella to cut and paste questions over to me that come through Facebook platform. Fernando is from Brazil. Super awesome. Thanks for being here. Right off the bat, asking about LIFO average price calculation. I already have a hedge account question mark. The competition is coming, and it already has. Okay, well, I'll get to those kind of platform questions. Let's get through, though, this idea of micro Nasdaq. And my name is Jim Cagnina. For those of you who do not know me, there's my email address down there, jim.cagnina@ninjatrader.com. Feel free to reach out at any time. I do want to remind everybody trading futures options on futures involves substantial risk of loss, not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although it could be an equation for opportunity, also an equation for risk. So be careful, only fund your future trading account with risk capital. In my personal definition, money I can afford to lose, doesn't change my lifestyle, doesn't lengthen my retirement horizon, and doesn't overly stress me out. Stress in life is important. We make bad decisions, at least I do, when we're under stress. So keep that in mind. Easy on the day trade margins, and we are logged into a real-time simulated live NinjaTrader account for today's presentation. And we're going to do most of the presentation from the actual platform here, because I think the platform tells a story pretty well. I do have a PowerPoint that I'll kind of refer to every once in a while, but feel free to ask questions as you go. Zolt is here from Munich. Thank you so much for coming. Appreciate it. Zolt from Facebook. Awesome. And I'll just kind of move the PowerPoint over to the side here. So right now, I have the NinjaTrader platform up. So we have It's modular. You could set this up however you want. You could have as many or as few windows open as you want. I'm kind of consolidating all of my stuff on one screen. And so I could do the presentation on one screen instead of two. I do have a multi-monitor setup with other windows on them, but just kind of starting at the top here. This is the control panel. I have a couple of sim accounts here with some sim money in them and some statistics on them as well. And we'll talk about that as we go forward. I have a trading ladder here. This is the NinjaTrader Superdome, and this is really where the rubber meets the road for futures trading. This is pretty impressive. I have the micro Nasdaq up on that. Quote board on the right-hand side called the Market Analyzer, where I have all the different asset classes here listed, all the different markets I'm looking at listed. And of course, we're going to focus on the NQ, which is the big classic E-mini Nasdaq, and the micro Nasdaq, MNQ, which I have highlighted here in green. And you can see there's already 1 million contracts traded. And if you look everywhere on my quote board, the only market that's traded more than 1 million contracts today at the CME Group is the 10-year Treasury note. So if you look way down at the bottom here, ZN. This is a liquid market. This is a deep market. And the bids and offers on the quote board on the trading ladder are a little deceiving, and I'll talk in detail about why that is. So I'm going to kind of make some more room here, some more real estate, and of course I have a chart. I have a mini Nasdaq chart, micro Nasdaq chart. So the micro Nasdaq is part of. You know what? I'm just going to pull this over. We'll go through this really fast. The micro Nasdaq is part of the CME Group's mini size contract suite. Right, we have a mini, and you can see the M's, an M in front of the symbol, MNQ. This is the micro Nasdaq 100. We have the MES, the micro E-mini S&P, the micro Dow, the micro Russell 2000. So all the stock index futures are represented in a micro contract. That's when I refer to the micro suite. We have micro currencies. We have micro gold is another example, micro Bitcoin. And so on and so forth. And again, I think the idea here is similar to kind of a fractional pricing is to give folks the ability to express their opinion in these particular markets with maybe a relatively different or less risk profile and maybe a smaller size trading account. Now you could fund a future trading account with hundreds of dollars instead of thousands of dollars, right? So this is really, the micros have kind of introduced this idea that futures trading is now accessible to just about anybody. This particular market's new, right? The Nasdaq was launched, the micro Nasdaq was launched on May 6th. 2019 and is wildly popular, as you can see by the volume numbers we talked about a second ago. It's 1/10 the size of the standard E-mini Nasdaq 100 stock index future, the original electronic stock index future, which was developed a couple decades ago. But this literally, it's 1/10. Everything's 1/10 the size. The margin requirement, the tick size. All the way across the board. It's a multiplicative math. It's 1/10. So if you bought 5 micro contracts, you would be long a half of a classic contract. So think of it that way. Cash is, this is related to the QQQs or the NDX, right? This is the Nasdaq. This is what we're talking about. So it's traded electronically on the CME Group Globex electronic trading platform. And there's the definitions: the premier electronic trading system providing global connectivity to all the broadest array of futures and options across all asset classes. And I might be jumping the gun here a little bit, but let me kind of let's talk about Globex, and let's talk about a regulated, transparent exchange that takes orders on a first in, first out basis. So this pricing that you see here in the trading ladder, we see bids and offers. On the bids on the buy side, offers on the sell side, on the trading ladder, and you can see they're dynamic. They're moving around like crazy, and you can see prices in the middle, which is that this yellow flag here tells us where the last trading price is. And I'll occasionally freeze the ladder here to kind of show it. And this is what I'm talking about: transparent pricing. A trader in Japan is going to see the same thing a trader in Los Angeles is going to see, as a trader in Brazil is going to see. Is a trader in Cameroon is going to see, right? You're going to see the same you see the same market. It's one, there's no middlemen, right? These orders and this data comes from the CME Group Globex electronic trading system. So when you talk about Globex, you're talking about not only speed and efficiency, but also orders that are accepted on a first in, first out basis, or FIFO, right? Fernando's talking about LIFO. But really what's important for retail day trading is to consider, when you send your order, you want consideration. No one else has a preference in front of you. No one can step in front of you in line, right? You get in line and you have a shot at getting your price. So that's kind of and actually, you know what, let me just show the rest of the slide. This is kind of how almost all of these CME Group markets now are traded through Globex. It started in '92. Remember the old days we had America Online Connection, when online trading platforms became popular in the late '90s, and then with the emergence of NinjaTrader, they've kind of taken it to the next level as a premier online futures trading platform. Transparent pricing. There's nobody's hiding anything from you. And again, first in, first out. So let's talk about 1/10 the size. It's a $2 point, right? It's a $2 point versus a $20 point. What do I mean by that? Well, the classic E-mini is a $20 point per contract. And the micro is simply 1/10 the size. It's a $2 point. Let's kind of let's freeze the trading ladder for a second, and let's just look at the price of 15,844.00. Right. So you'll see the next increment up. The smallest tick size is a quarter. It's a quarter point, 0.25, and then the next one's 0.5. The next one's 0.75, and then the next one is 85 even. Right. And so each increment is worth 50 cents. 4 increments, so 50 cents times 4 equals $2 per point per contract, right? Again, 1/10 the size. If this were a classic E-mini, then it would be double. And maybe a good way to kind of show that, it would be times 10. Sorry, a good way to kind of show that is I'm going to duplicate this right now. And then I'll just unlink the instrument, and I will just type in NQ here, and we'll hold them side by side. So these are on the left-hand side here in my trading ladder. I'll have a classic E-mini NQ. There's no M in front of the symbol. It's NQ. And then on the right-hand side, I'll have the micro. So I'm just going to go ahead and real quickly just do a market order in both, right? I'm just going to click a market order in both. And so we can see how P&L moves at the bottom of the screen, right? So at the bottom of the screen, you can see, and again, these were just random orders. Don't police these at home, just random orders. Just to kind of demonstrate function. And then you could see the differences in the P&L, right? $50, $55, 20, 40. On this side, minus 50 cents, minus $1. So again, this behavior, this 10 to 1 relationship behavior is 100% correlated between these two markets, as is the pricing is 100% correlated. So keep that in mind as well. These are the basis of this market is the exact same. And it is 100% correlated. So just to kind of complete the picture with the PowerPoint, quarter point, 1 tick, smallest price increment, 50 cents. Traded 23 hours a day. We're literally going to start trading 6 o'clock in the evening, Sunday, going all night, all morning, all day until 5 o'clock in the afternoon. And these are East Coast times. I'm talking about East Coast, New York time. 6 to 5, 23 hours. Then there's an hour break between 5 to 6 Monday. And then Monday night, it resumes again, 6 p.m., all night, all morning, until Tuesday at 5 o'clock, then an hour break. The cycle repeats itself all the way through Friday. Then Saturday, take the day off, be with family and friends. And that's good. Cross margining with the standard size contract. We already kind of touched on that a little bit. So as an example, let's do a cross margin here. On the left-hand side, I'm long one classic E-mini. On the right-hand side, what I'm going to do is I'm going to sell 5. So I'm long one contract. I bought a contract on the left hand, in the classic, and I sold 5 micros on the micros. And so the net effect here is that I am only long a half of a classic E-mini, or 5 micros. So it would be 1 minus 0.5, if that makes sense. So that's how cross margining works. So when you look at your overnight margins, it will reveal that as well. All right. Any questions on that type of min? Be happy to talk to you about it more in detail. All right. There's 4 contract months: March, June, September, December. And without getting too far into the weeds, in futures trading, you're not trading shares, right? You're not trading shares in a corporation. You're not buying an option. You're trading contracts. You're buying and selling contracts. You could sell a contract before you buy a contract. You could buy a contract before you sell a contract. And the expectation here is that nobody ever takes delivery on the contract, right? And you just continue to trade. You liquidate positions, establish new positions as you go forward, whether you're day trading, swing trading, or position trading. And if you are position trading for a long period of time, and you need your contract to survive for a long period of time, then you simply just roll that contract into the next front month. Right now, our front month is March, which is represented by the 3 in the quote board. 3, MES 3, MNQ 3, and then 2000, and then 22 represents the calendar year 2022. Okay, average daily volume in this particular market, it's huge. It's huge. This is an old slide. I mean, I took this in the middle of November. I captured this from the CME Group website, and it kind of just shows a PowerPoint. I mean, a bar chart here that shows both volume and open interest on a daily basis. And you can see it's substantive. I mean, volume is routinely over 1 million these days. Which is a huge amount of volume. And the good news is that means there's liquidity in the market, right? The more volume, the more liquidity. So that's pretty good. Now, the bid-ask spread is a little funky here, but it has to do with the relationship between the point size and the price movement in the actual index itself. It moves around fast. So bids and offers don't stay in the book very long. They're entered and exited quickly. So you see that popcorn effect, and it's, as you can see it in action as we're looking at it right now on the right-hand side of the screen. So from volume, we're in good shape here. Open interest, we're in good shape here. And notional value is pretty, it's a big notional value contract. Truly, you can multiply 2 times the point. Times the point value. So it's $2 times the price. And what notional value is how much value you control in a particular contract. Excuse me. If this were the classic NASDAQ, it would be $20 times the price, right? And that notional value changes as the market price changes, for sure. As an example, $2. When I first started this PowerPoint, price was at 16,330. You multiply those two things together, and you get a notional value of $32,606. And that's a lot of notional value, even though it's just called a micro. The NQ, the big E-mini NQ, would be 10 times that, would be $326,060. And now you can start seeing the relationship between notional value, the size of your futures trading account, and how much leverage you employ. Things could really get out of hand quickly. So you got to be easy on the day trade margins. Bid-ask spread, bid's the highest price someone's willing to pay. Offer or asks, offer is kind of an old-fashioned way of saying ask, is the lowest price someone is willing to sell. And the bid-ask spread is part of your transaction cost. I'm going to freeze the ladder right here. And you can see the highest bid right now is at 87 3/4, and the lowest offer is at 88 and a quarter, and the difference is 2 ticks or $1, right? 50 cents a tick. That's the difference. And then, it's sometimes it's 1 tick, sometimes it's 3, sometimes it's, but it's relatively tight, And so the spread, we refer to the spread as the difference between the bid and the offer. Tighter the spread, the better off you are. MNQ could be as low as 1 tick or 50 cents. Right now it's looking at, on average, just eyeballing it, it's looking at like it's a couple ticks. So be careful with market orders. You're going to get filled at your best available price, which means you can get some slippage, either good or bad. And it's something to keep in mind. Entering orders and exiting orders on limit orders, in my opinion, are oftentimes best practices. Because you're going to pay the spread. Okay, so what is the NASDAQ 100? And we'll get into some trade examples and trade ideas in a minute. It's 100 leading non-financial U.S. large cap companies. It's no longer just tech firms. I mean, there's a lot of tech firms in it, but it's non-financial by definition. It's a modified capitalization weighted index. Bigger companies have a bit more oomph in terms of the price calculation. Now, this is different than the NASDAQ Composite Index. NASDAQ Composite Index is different. This is just the NASDAQ 100. So larger companies in the NASDAQ. Some of them include Apple, all of them you're familiar with, Microsoft, Google, a couple of different alphabet classes, Amazon, Tesla, and then I don't know if it's called Facebook or Meta Platforms or whatever it's called, are some examples of some of the larger. These are well-known entities that everybody follows on TV, and you probably own some of these shares in your portfolio. Who knows? So this is why there's an emphasis, because it's a modified capitalization weighted index. There's an emphasis on looking at what Peloton's in this group, and it's a very small, relatively sized company, and so less people are going to be interested in Peloton's impact on the NASDAQ 100 than when Elon Musk sends a tweet at 7 o'clock in the evening, or does something that might be considered crazy. So modified, capital in a smaller size index like this is kind of important. So one of the benefits, though, and I'm probably jumping ahead in the presentation, one of the benefits of being able to trade a NASDAQ, E-mini Nasdaq, or a micro NASDAQ in the evening is you don't have to have a pattern day trade account to do it. You don't have to have an uptick rule kick in to go short, and you could participate in the evening if there are after hours earnings that are being announced for one of these companies, or in my example, Elon Musk quotes something crazy, right? Those kind of things could move, and you're best positioned to be able to do this in either a micro at night or in a mini NASDAQ at night as well. One of the advantages of futures trading, not having to have that pattern day trade account and seeing the entire liquidity pool in the evening instead of whatever your broker is showing you on the equity side. So globally recognized benchmark. Everyone follows the NASDAQ 100. It's on TV in the morning when you wake up. It's on TV in the morning when you go to bed, and it's widely recognized and widely traded in some form, shape, form, size, or another. Capital efficiency. Again, you could fund a futures trading account with hundreds of dollars instead of thousands of dollars now, right? And so freeing up your other capital to do other things with it. Again, I'm going to recommend everybody risk capital only. The money you can afford to lose doesn't change your lifestyle, et cetera, based on your personal definition. Overnight margin, exchange minimums are a lot less. So if you're holding positions for a long period of time, you're expressing your opinion that the NASDAQ is going to appreciate or depreciate over a long period of time, it's easier to hold positions in a micro because the minimum amount necessary in your account is going to be less as compared to a regular, larger size contract, or even an equity-based contract. Intraday margins, again, are even lower than those overnight margins in most cases. Be careful with it, be ginger. And then you have a scale in, scale out ability. And we're going to do some trade ideas and examples on scaling in and scaling out of an actual trade. We're going to go ahead and make one and talk about it. You could day trade, swing trade, position trade. It's, those are three different definitions, right? Day trades are for, trades that are liquidated within the same session. Sometimes those trades are established and liquidated in seconds or minutes. It just depends on your trading style and what your particular desire is. Swing trading, typically people are looking to take advantage of a swing move up or a swing move down, which could occur quickly, or it could take some time. And then there's a position trade where it's more of, think of it more as an investment approach, right? I want to be long or short in this particular market for a long period of time because the fundamentals are telling me X, Y, Z. So again, potential to hold positions with smaller size accounts is a benefit. After hours earnings and events, we already talked about that. No pattern day trade rule, no uptick rule. Centralized volume distribution. You can see it here. I mean, there's no market. We're not, order flow is not being sold to market to another liquidity provider somewhere in an ECN off to the left, and then there's another pool to the right, and you don't see everything here. It's centralized. Let's take a look. All right, let's get into it a little bit more detail. So Jay says, so long as you stick to day trades, particularly your potential loss, place your stops, trade high volume futures, and are sure to get out early well before close, the risk theoretically is no more than stocks, is it? That's not true. That's definitely not true. We'll explore that. Let's take a look at some. Let's take a look at the charts here. All right, so right here, here's a micro Nasdaq. This is a 10-minute chart, right? This is a 10-minute chart. And if you want to even go back in time, actually, let's go back and do let's take a look at a daily chart. Here's a daily chart. So Tuesday, Wednesday, and Thursdays, we do live trade setup events. We talk about market structure analysis and all that stuff. And this daily chart, we started off looking at a daily chart. And here's a daily chart. And remember, this structure of the market is going to be identical, or at least nearly identical to the classic E-mini S&P, classic E-mini Nasdaq. The micros, it's the same basis. It's nearly 100% efficient. And all I have here is a daily candle chart. Green bars are up bars, red bars are down bars. I have a Fibonacci retracement that I put up here to show me some areas of interest. And then I have an oscillator at the bottom. In this particular case, I have a MACD. LAFTA, yeah, we'll talk about that. Sounds good. MACD oscillator at the bottom to give me a sense of momentum and direction. Right, so I'm taking a peek at this right now, and what do I notice here? Well, I have an area of support that I've developed with my dotted line here manually. I might see a 1, 2, maybe triple bottom phenomenon where we can't really close below that 50% retracement level at 568, and so these fib lines are key levels to me to kind of match. Really big wick a couple days ago. Buyers came back in. Anybody who traded Monday knew Monday was a crazy day. But these big tail or big wick on this candle tell me buyers came back in strong and said, no, we want to be above Jim's dotted line, and we are. Right. So we're moving back up right now. There's a lot of factors going into this market that's going to determine what happens with price in the long term. We have the Fed stuff, interest rates tapering, asset reduction. We have the COVID variants that are kind of mucking up works a little bit as well. That could cause other things. In addition to regular, PE ratios and earnings reports and things like that. So this is kind of our first thing we look at. All right, this is a nice structure here. Looks like we're kind of rebounding nicely, looking for places to buy as a general rule. And so we'll go through that whole process in the mornings. And then let's take a look at the 10-minute chart. Now we want to talk about day trading. You know, what do we want to do from a day trade point of view? Do we want to, you know, do we want to go long? Do we want to go short? And we're going to place some trades. I'll place them off the charts, or you could place them even off of the trading ladder, whichever is easier for you, whichever one you prefer to do. So what I'm going to do is I'm going to use my volume profile on the left-hand side to show me areas of interest. I'm going to use my my oscillator as a different one this time. It's the commodity channel index at the bottom here. And I'm going to have a moving average cross, which looks like it's converging. It's coming together, right? It's getting the fast moving average, the 6-period average, the slow moving average is a 26-period moving average. So when we talk about the ability to scale into micros, and let me give you an example of what that might look like. So as an example, I'm going to go ahead and identify an area of short-term area of resistance. I'm going to use a rectangle technique, and I'm going to put this rectangle right to the top of the previously high body of a candle, right? And which is right there. Actually, it's not, because we just had a candle that closed, so it's right here, right? So this rectangle right here, the bottom of my rectangle is touching the top of the highest closed body of a candle, and I'm saying, hey, this is an area of resistance. We haven't had a candle close in this area for a very long period of time, right? Extending all the way back to 1030 to 1040 bar. So one might say, well, I would like to sell a unit if we kind of, if we get back into that rectangle, because I don't think we can close in there, and I think it's going to go back down. So I would do simply just right click. I'd pick a price. I'd right click, and I'd go ahead and send an order to sell a contract. This is a limit order, and I'm saying, hey, I want to sell a contract at 911.5, my price or better. That's the definition of limit order, right? It can't give me a worse fill, but it could give me a fill at my price if the market goes up there. And you can see there we go. We see it. We got filled very quickly, and now we have created a short position. We're -1. We're red. It's color coded. We're short. Our hope is that the market's going to go back down. And we'll be able to buy it back at a lower price later. And I'm just going to use the point of control, volume point of control here at 870.5 as a target. I'm just going to go ahead and put a buy limit in here. So now what I'm saying is, hey, I would like, if the market comes back down to my price, I think it's going to come back down here at 870, and I would like to buy it back, and I would create a flat position. Right now I'm short, I'm -1. I only have one unit on, or one contract on. And then if I look up at the top of my screen, I could see what my day trade margin is, $100. And that's not money I've sent. It's just money that was in my account that's allocated to the position. That's all it is. It has nothing to do with, I don't have to wire money out. I don't have to do anything with this. It's money that's in part in my account, but this $100 is allocated. It says, okay, you're using $100 of your available cash value to place this day trade. And then there's my access initial is still very large in relationship. The next column over here says initial margin. And this is not what your broker decides. This is what the exchange decides. And the exchange says, hey, Jim, if you want to hold this position past the close in 5 hours from now, or however long it is, then you have to have at least $1,760 in your account, which we do, right? Our excess overnight margin, think of initial margin as overnight margin, is $3,360. So I have the ability to do that. Now, if this were a classic Nasdaq, E-mini Nasdaq, this initial margin would be 10 times bigger, $17,600. That's a lot of dough. And you may or may not have that, an account size that is that you're interested in doing that with, right? That could be a lot. So again, this is another kind of benefit of the micros, is you could hold this position for a longer period of time. The firm says good afternoon. Good afternoon too. Morph, I'll show you how to do the colors. Hang tight. We'll do that at the end. All right. Oh, shoot. Hang on 1 sec. I forgot to turn the phone off. Let me do that right now. All right, it will not ring again. Sorry about that. All right, so we're back. Let's kind of go back here and you see prices are kind of moving around. Now, we talked a little bit about, the margin requirements and all that stuff, and we have a realized P&L column here in the third column over from the right. These are trades that were closed earlier. And now we have an unrealized P&L. What an unrealized P&L is, it's just saying, hey, Jim, if you liquidate your position right now at the market, this is how much money you would lose, $8, right? And then, unrealized plus realized equals total P&L on the day. Again, looking at this through the lens of a day trading point of view. Now, scaling in and scaling out. If I were to scale in this particular trade idea, and let's go ahead and pick a number. Let's go ahead and pick, I don't know. I'm just gonna look at my chart right now and say, you know what, I'd like to have, if we get to the top of the value area, this is this 940 number here. And don't worry if you don't know what that is. We talk about that Tuesday, Wednesday, and Thursday in great detail, but I like to sell another unit. So I would send an order to sell another unit. Right. So right now what we're looking at on my screen is we have a position from where my label is. We have an order to sell another unit up at 930. Let's make it an even number so it's easier to do the math. At 939. If the market goes up there, which we're getting close to, then I would like to sell a second unit. They would create a position, a short position, right? It'd be short 2 contracts instead of just 1, right? So now I'm scaling in. Now my average price is going to change, right? The average price, it won't be 911 and it won't be 939. It'll be halfway between that point, right? Is the second unit in the trade idea. It's 12:35. We have a long time before this candle exhausts itself. And, we'll see if, and again, everything's mimicked in the trading ladder. You can see it there. We're getting close to our price. But, we're not going to get that fill until the market hits that price, 939. Then we're in line, right? First in, first out. And there might be some, some contracts that are ahead of us from other traders that have sent them to the order book. I don't know. In any event, we're going to be patient and wait to see if we can get our second unit. Now, you could, if the second unit is achieved, and I'll probably force it in a minute just for demonstration purposes, but we would be short 2, and that would be equivalent to being short 20% of a classic E-mini S&P. Look at my day trade margin. My intraday margin now is 200. It was 100, but now it recognizes the potential for a second unit since I already sent an order. And if this were a live account, this would be at the CME Group's electronic book. So it's saying, hey, now you're using $200 of your day trade margin, and your excess margin now is only $4,893. Initial margin hasn't changed because the overnight margin hasn't changed because I don't have a position yet, right? Once I do get a position, then this will double. And then all the math works out the same way it works out. So any questions so far at this point related to the micro Nasdaq or trading the micro Nasdaq? Pop them in right now. Nope, okay. So what I'm going to do is I'm just going to kind of drag this down a little bit. I want to get my second unit. I kind of forced it a little bit. So now I have a 2, right? -2. My average price jumped up from 911 to 921. And let's take a look. My intraday margin is still 200. My excess margin is 4,880. And that changes as my unrealized P&L changes. My initial margin now is double, 3,520. My excess day overnight margin is 1,562, right? So I still have excess margin. I'm using, 35%, I'm sorry, 70% of my margin, which is a lot, but I'm still in good shape. I still could continue to hold this position for if I wanted to at this point. Now, as the market moves for you or against you, this number is going to change, right? It'll get bigger or smaller. Realized P&L is the same, and then unrealized is minus $44.50. And so now you see, now we're starting to see, hey, wait a second, these micros could actually add up. I mean, I'm losing $46 already. Alternatively, if we took the other side of the trade, we'd be up, $45 already, and it starts adding up. It's not a small market anymore. It's a big market. There's a lot of potential and risk at the same time with respect to this particular market. So keep that in mind. I'm going to go ahead and do a third unit, right? Okay, I'm going to scale into another unit and send a limit order there to sell a contract if we get back up to that 940 level, 941 level. So what are we seeing on our screen right now? We see a situation where we have a 2-unit short position, 2 contracts. We see we're trying to sell a third unit up at 940, 941. And then we have one profit target down here at 870. And one might say, wait a second, why don't we have a 2-unit profit target? Well, we could do a couple of things. We could change this 1 to a 2 and say, all right, if the market comes back down here, I want to buy 2 contracts back at 870, and that's my profit target. Alternatively, let's move this back to 1 again. I could scale out of my position, and I could say, you know what, if we get to the bottom of, actually my rectangle is no longer any good. I got to keep moving it up, which is fine. Let's just say, hey, if we pick a scientific level here and kind of look at this second node in the volume profile here, this volume distribution is pretty nice. That'd be a good target, I think, to consider maybe buying, trying to get my one of my units, bought back. So here's an example of scaling out of a position, right? The market comes back down here. I'm going to go ahead and, if I'm fortunate enough, I'd buy one back here, and then it would leave me with a -1 or short 1 contract. And then with the hopes of this continuation price depreciation to continue to go down and get the second unit. So Morph says, nice distribution. This is really a Tuesday, Wednesday, Thursday discussion, but let's talk about it. Morph says, nice distribution, bell shape on the volume profile. Does that mean a trading range? So it's a relatively nice distribution on if you think of a Gaussian shape distribution or a bell shape distribution on the volume profile on the left-hand side. And again, this is unique to futures trading. You don't get this. You're not going to get a single view market volume profile in any other market, any other market, tradable market. In my opinion, this is one of the unique factors of trading futures. But let me point out that we have a volume node here just above my dotted blue line here, which is above the value area. We have a competing point of control where my first profit target is lined up. And then we have the legacy point of control, which is down by where my second profit target is lined up. And what I mean by point of control, these are just the longest histogram bars, the price where the most volume has traded so far today. That's all that is. It's not magical math or anything like that. So this is a relatively decent setup because it gives us these nodes which are areas of interest for sure. And now looking at that, even if I wanted to be less aggressive on my third unit for my sale, I would probably line this up a little higher up into prices above value where I see this volume node as well. Again, an area of interest. So we're going to leave it there for now and see what happens. Thank you for that, though. Lefta says MYM, MNQ, M2K, MES. What's the best to trade? All right, so that's a tough question. That's a good question. And what Lefta is asking is, hey, you have 4 different stock index. I'm going to call them benchmark stock index futures. You have the S&P 500, the Nasdaq 100, the Russell 2000, which is small cap U.S. stocks, and the Dow Jones, which is the Dow Jones, right? Blue chip, been around forever. Everybody knows what Dow Jones is. So if you take a look, the first clue is, what's the volume? What's the volume comparison here? And the micro E-mini S&P has 800,000 contracts traded so far today. Pretty impressive. Again, notional value there would be tremendous, right? You would multiply 802,000 times the price times $5. So 20,000 times whatever times 802,000. Huge notional value. The classic E-mini S&P is a little bigger. It's got about 1 million. The NQ, the micro NQ, has over 1 million, which is leading the charge on volume. And then the classic NQ is half of that. And why are so many people trading the small one instead of the big one? Well, I'm going to argue, again, my opinion, is because you could do things like scale in and scale out. You could do things like place your stop loss a little bit further away than you ordinarily would to avoid, regular normal volatility, because the risk profile is less than that of the larger size contract. So it gives you more flexibility in trade management, I think, in my opinion. Let's take a look at the Dow, right? Dow is down 43, micro Dow. The daily volume is 109,000, like 10% of the NQ. And then if you look at the Dow, the classic E-mini Dow, it's 127,000. So it's bigger. The Dow is a $5 tick. So I would focus on the $5 tick Dow instead of the micro Dow. That's just my opinion. And pretty much the same for the Russell's come a long way, right? We have 130,000 traded so far in the micro Russell, right? That's more than that's traded in the micro Dow. We have the classic E-mini Russell at 124,000. So that's a wash either way. I think they're both liquid enough to participate in, and it would be a coin flip up to me. But otherwise, just going top to bottom, my personal preference is the classic E-mini S&P, the micro Nasdaq, the classic YM, and then I don't really focus on the Russell 2000 that much. So that's how I'd answer that question, Lafta. Again, though, don't overdo your risk exposure. Risk capital only, take it easy. So when we talk about, and going back to Jay's comment about what's riskier and what's not riskier, I think what a lot of people don't understand, what people tend to forget, is that even without a day trade margin, you have a tremendous notional value, a lot of buying power with when trading futures. And as an example, if with futures trading at let's just call it 16. No, we'll do exactly what it is. It's 15,915. Again, I'm going to multiply that by 2. I have a notional value of 31,000. If I were to fund my futures trading account with 31,000 instead of 3,000, then I wouldn't have any leverage. It'd be 1-to-1. If I was to fund my futures trading account with $3,000, then it would be 10-to-1. If I had $300 in my account, well, then it'd be 100-to-1. So when you think about leverage ratios, you got to decide how you're going to apply those leverage ratios across all the asset classes that you're actually going to invest in or trade in, and then you come up with the answer. So, the riskiness is a function of how well capitalized you are in most cases. And if you fully capitalize your micro account at $31,830, you'll have no leverage, and that would be, maybe like trading an NDX as an example. So it's really a function of that, and it's a hard concept to get in your head, because so many times most day traders and trading futures, at least in my experience, will fund with less risk capital and take advantage of those overnight and day trade margins. But the negative there, of course, is it affects your thought process. It affects your adrenaline, your dopamine, your serotonin, all the things, impulse control factors that we really can't control. So that's a whole nother psychology of trading course we could talk about another time. Okay, while we're waiting, I just want to see if we could pick up a unit here. So we're going to be patient and wait. Market's kind of lunchtime, things are kind of slowing down. Someone asked about the market analyzer and colors. When you right click on the market analyzer and you go to columns, you could add a bunch of different columns, right? And you can see the columns that I have added here. And if you want to change the color like I did on the net change, you just select it in the configured section. I forgot who asked this question. It'll take me like all the rest of the webinar to figure out who asked this, but I'm going to click on that change. And then under sell conditions, I'm going to add 2 conditions. I'm just going to click on the sell conditions. And, I'm going to say, okay, well, my first condition is, I want the background to be light green. And my trigger is going to be, that the price is greater than or equal to 0, right? So if we have a positive price, then it's going to be green. Alternatively, my second condition is it's going to be light coral, or I guess you call it light red or pink. I don't know what that is. Light coral. We'll stick with that. It sounds official, like an official color. And then my condition is less than 0. It's going to color it. It's going to color it that. So that's how you do it. It's pretty easy to do once you know the trick. Okay, so something happened here. We got an order filled. Okay, so we have our third unit now. So let's take a look. Our third, this isn't going well. It's the market's going against us. We have an intraday margin now is $300, right? Which is what it was when we placed that limit order. Now my initial margin is 5,000. My overnight margin is 5,280. My excess initial margin is minus 247. And so it's negative, which is saying, hey, I don't have enough money to hold this past the close, right? I don't have enough money to hold this past the close. I either have to liquidate one of the units, or if we were to approach the close in this condition, or liquidate them all, however many I wanted, but at least one, in order to maintain that excess initial margin or the overnight margin to be positive. So that's a good example of how that works. Now, every tick now is no longer worth 50 cents. It's worth $1.50, 50 cents times 3. All multiplicative math, all easy to understand. So I've scaled into 3 units. I have 2 targets down below here. I could do a couple of different things. I could add another target. I could change one of these 1 contract targets to a 2 contract target if I want, to balance out the 3. It's totally up to me. Let's just go right click and put a random order in. So now I have 3. I have 1, 2, 3. That balances out my short. My average price right now is 927. The average price keeps creeping up as we cost dollar average in, or however you want to call it. But as long as the strategy is kind of developed in advance ahead of time, it could be a useful strategy. Sometimes folks just kind of keep cost averaging in because they're frustrated that their initial trade idea was bad. That's not a good practice. That's a bad trade practice. So you wouldn't want to do that. But coming up with some scientific levels like point of control, top of the value area, competing points of control, candle structure, those kind of things can give you some areas of interest where you may want to enter a multi-unit trade. Okay, so let me just look at my notes here. I think we covered everything. Well, we didn't cover everything. We covered a lot of ground today on this. Again, these micros, the micro complex, the micro suite, whether you're talking about currencies, you're talking about gold, you're talking about the stock index futures, really gives some flexibility with respect to most folks to be able to participate in these markets. Morph gave me the thumbs up. Thanks for that. Janio said WTF, and then has a crying face. Not sure what that's all about. Level 2. Thanks for being here. Any other questions from Facebook, anywhere else that I missed? We're going to throw up the platform training link into the chat boards right now, so you can see what's up and coming. We do have some stuff that's up and coming. Tuesday, Wednesday, Thursday, live trade setups, 10 o'clock a.m. Every week. Feel free to join us at any of those. We have today's special event was on the micro Nasdaq. Tomorrow's special event is we're going to go into detail on futures margins, what they are, why they're unique, why they're different, some pitfalls, some benefits, and all of that stuff. And then we have some how-to events regarding the NinjaTrader software the rest of the week. So feel free to join any of those also. Isabella just cut and paste those into all three of the chats. So we are good to go. And I do want to remind everybody, trading futures options on futures involves substantial risk of loss, not suitable for all traders and investors. Easy on the day trade margins, risk capital only. Scott, thank you. Appreciate you being here. I appreciate that positive feedback. Appreciate the thumbs up button. If anybody is interested in the YouTube channel, there's a thumbs up button. That'd be awesome. Jay, thank you. And that's it. So hopefully I'll see you again soon. And just want to end with, be safe out there and be good to each other. Take care.